Good morning everyone. Today we are going to discuss about insurance. So all you know that future is uncertain. What could happen in near future we cannot determine so right now. So to secure the future, people they do prefer to take insurance. So insurance is what? Insurance you can say that is a mean of protection from the financial loss that could occur in the near future. And apart from this, it is a form of risk management that is primarily used to hedge against the risk of a contingent or uncertain loss that you cannot thought of that what exactly is happen to go in next moment, and you are going to secure that movement, or you can say you want to protect yourself from that risk, so you will go with the insurance. So here we are going to talk about this topic insurance. So now we are moving ahead with the second slide, that if we talk about the insurance, so if you see this point, very first point, if you'll see, it is a contract or way to manage your risk. You understand that as we know that future is uncertain, so there are lots of chances are there, different kind of risk that can affect you. It can be related with a life risk, it can be related with the goods or raw materials you have in your organization. Maybe they are going to, that particular thing is going to get fire. So because of that, you are going to face some kind of risk. Now the question is that how you are going to manage that uncertainties, how you are going to manage your the risk that could occur because of the different condition. So this is one and one only solution, that is insurance, that is going to provide you help into this. And apart from this, if you are talking about that this is a contract, so basically this is a legal contract, and you can say that it is bound by all the legal boundaries. And one of the organization that is working in India, you called as IRDA. IRDA. So IRDA stands for Insurance Regulatory Development Authority of India. So this provide rules and regulation so that every single individual organization that is providing insurance, so they will not make any kind of fraudulent activities against the individual insured person. And whenever the insured person is going to, or you can say if they will ask for the claim, so at the same moment the organizations, insurance organization, they will not deny so. Now apart from this, when you buy insurance, you purchase protection against unexpected financial loss. As also I've told this thing, that when you are talking about insurance, when you are purchasing insurance to secure your future, it means that you are securing yourself from the unexpected loss, that could be financial loss, that can be a mental loss, or that can be any kind of other loss, financial loss. So you are protecting yourself against that particular kind of risk. Now next one, if we say about insurance, the company from where you buy a particular insurance will pay you if something bad happens to you. So before telling you about this, I want to tell you, whosoever the insurance company that will provide you the insurance facility, that will be called as insurer, and the individual that is going to avail the benefit of that insurance policy, or you can say that will pay certain premium to the insurance organization, so that will be called as insuree, or either you can call as insured person. So now apart from this, all you know that those who are the policy holders and insureds are often used and but are not necessarily synonyms, means they interchangeably we generally use it, but they are not synonyms, you can say, the policy holders and the individual insured person. So you can say that as coverage can sometimes extend to additional insureds who did not buy the insurance. And apart from this, the insurance transactions involves the policyholders assuming a guarantee that known and relatively small, in the form of payment to the insurer, means whatever the premium they are going to pay, in exchange for the insurer promises to compensate for the financial losses that could occur in near future. And the loss that we are talking here, the loss may or may not be financial, but it must be reducible to financial terms. Means to say, we can calculate the loss in the financial term. Furthermore, it usually involves something in which the insured has an insurable interest established by ownership, possession, or pre-existing ownership. Let's say if I'm saying I'm going to take insurance of my home. So how I can take the insurance of my home? If I have the ownership of home, then I can take the insurance. I do not have the ownership of my neighbor's house, so that's why I'll not take insurance of their house. I'll take insurance of the property that belongs to me, and I should be the owner of that. I hope this is clear with everyone. Now we are moving ahead with the classification of the insurance. So we talk about the classification of insurance. So basically it can be categorized into two categories. That one is general insurance, another is life insurance. So general insurance, we can involve here the insurance that is excluding, or you can say that is not related with, if it is not related with the human life, except human life, whatever the other things are going to cover, or whatever the risk that is going to cover for that is comes under general insurance. Let's say we are talking about health of an individual, we are talking about motor, let's say car, automobiles, bike, or we're talking about any, like let's say Mr. Doodle is there, one of the individual that want to go to travel abroad, or to want to travel to from one place to another place, so want to secure his traveling, so they can also take insurance. And one individual, Mr. XYZ, is there, he is having a home, want to secure the home from the uncertainties, so he or she they can take the insurance for the same. And apart from this, let's say you're running a business house, you have different kind of raw material in your business house, so to maybe the chances a fire can be occur, so to protect your individual organization from such kind of incident, you're going to take fire insurance. So apart from this, different type of other insurance are also there. Let's say you can call as boiler insurance. In big organizations, those who are manufacturing, let's say those who are making, not manufacturing actually, those who are making, like those who are doing extraction of oil, or you can say, or maybe in the some of the steel companies, different kind of boilers are utilizing by the organization, so they are having, that is having lots of money, there is lots of investment is there, so to protect, if any kind of loss will be occurring in these boilers, so that can affect the financial loss in terms of, you can say, in up to big extent, it can affect the organization. To protect their self from such kind of incident, they will take the boiler insurance. Now apart from this, if we talk about this insurance, like let's say health insurance. So health insurance is what? In the general insurance, health insurance policies are going to cover the cost of, like let's say medical treatments, dental insurance, like medical insurance, protect policy holder for the dental cost. And in most developed countries, if we say, all citizens receive some health coverage from their governments, and whatever the taxation they have paid, because of that they are providing that coverage. In most of the countries, health insurance is often part of an employer's benefits. This is available in India also. And now apart from this, like if we talk about another kind of insurance under general insurance, that is, you can say, income protection insurance. Okay, so under this, there are different kind of insurance are there that is going to involve, let's say, disability insurance. So let's say one individual is working somewhere in an organization, Maybe because of that there could be some kind of incident occur over there, that individual have got some kind of short-term disability, or you can say a long-term disability. So to cover that individual from such kind of uh, disability, or to protect against the losses that could occur because of this disability insurance also provided by the different insurance companies. And next one, you can say under general insurance, that you called as casualty insurance. Casualty insurance is going to involve under insurance against accidents, not necessarily you can say tied to any specific property. It is a, you can say, a broad spectrum of insurance that a number of other types of insurance could be classified, such as auto, worker compensation, and some kind of liability insurance that can also involve. Under this we can also involve the crime insurance. That could be one of the form of the, you can say, casualty insurance. Another is like you can say under this particular category casualty insurance, that is terrorism insurance. So it provides the protection against any loss or damage caused by the terrorist activities. Like one example here I want to tell you, that in United States, in the when it was this incident was occurred in 9/11, so the Terrorism Risk Insurance Act that is applicable over there, this is Terrorism Insurance Act 2002, so set up a federal program that provide a transparent system of shared public and private compensation for insured losses resulting from acts of terrorism. So different people, they got coverage under this particular act. Now apart from this, in this kind of casualty insurance we can also involve kidnap and ransom insurance, and they're designed to like protect the individuals and corporations operating in high risk areas. And apart from this, you can say around the world, high risk areas around the world, like perils of kidnap, extortion, wrongful detention, and hijacking. Another kind of like insurance that can involve here, that you called as political risk insurance, and this is one of the important casualty insurance, that is a form of like that is going to provide you some kind of losses that occur because of some kind of operations of the business activities in some of the countries where different kind of political changes are going to be occur, and because of that political condition you can face the losses. Now if you talk about the second category of insurance, so that is life insurance. So life insurance is what? Life insurance that will provide monetary benefit to a descendant family, the person that is a survivor after the descendant, so that can live their life after the person that means you can say that individual is now not now with the individual that family, but their survival is possible because of the life insurance. Life insurance policies basically you can say that often allow the options of having the proceeds paid to the beneficiaries either in lump sum cash payment, or you can say in the form of annuity. Now apart from this, if we talk about the different categories under this particular life insurance, so if you will see here, that could be a term life insurance. So term life insurance is basically what? That insurance company, like let's say yearly you are paying some amount of money, and let's say a maturity time period for that insurance policy is 15 years. So maybe in that 15 years, if we are not facing any kind of like health issue or anything, so or maybe any kind of accident or anything, so the insurance company, let's say after 15 years, they will not pay you any single amount that you have taken the insurance. Means to say that will cover only the risk that could occur between in that 15 years, and if there will be and if nothing is going to occur in your life in terms of accident or any kind of other such activities that could make your loss, so they will not pay you any amount. Next one is whole life insurance. As its name suggests, it will cover the whole life risk of an individual, and it is generally, you can say, uh, this could be one of the better opportunity for individual that cover your life risk, that could accidental risk, that could cover and also provide you a lump sum amount after the maturity. Next one is endowment policy. Endowment policy is somewhat similar to whole life policy. So you can say that at the time of maturity, you will get some amount of money after whatever the premiums you are paying. So based on that, you will receive some amount of money over there. Now next one, the child plans are there if you want to take, so that also covered under life insurance. Any kind of pension plans are there you want to take to secure your old age, so this is also available under life insurance. Now further we are talking about the next category. Like if you talk about the general insurance that already we have discussed, so I'm just putting some or you can say few glimpses about this particular general insurance. So you can say that those insurance contracts that do not come under the ambit of life insurance, you can say that this is not going to cover the human life. So these are non-life insurance products, and these type of insurance provide coverage to other aspects and assets in a person's life. In India, if we say, so there are total 33 general insurance companies in India. Some of the example I want to tell you, that is SBI General Insurance, Tata AIG, the Oriental Insurance Company. Now further we are discussing that is related with life insurance, that already I've told you. As its name suggests, those insurance that comes under the ambit of life insurances. Now, apart from this type of insurance provide cover to the life of a person in their difficult times, or you can say the descendant survivors are there that can that is going to cover under this. Basically provides financial securities to the nominees in case of an unfortunate event. There are different kind of, you can say, a total of 24 insurance companies in India. Some famous life insurance companies in India are Life Insurance Corporation of India, that was developed in 1956. SBI Life Insurance Company is there. Another is Bajaj Alliance General Insurance is there. So further we are moving ahead with the other insurance. You can say now we are talking about the types we have already discussed. Now we are going to talk about the principles of insurance. So basically there are 7 principles of insurance are there. One by one we will discuss all this. So if you talk about the principles of insurance, the very first principle, that is principle of utmost good faith, means to say how the good faith is going to create between an individual and an insurance company. First thing, that all the documents related with the policy that should be written in form, and no insurance company can enforce you that you have to take insurance from there only. And apart from this, you can say all parties entering a contract to act, they will show their honesty. There will be no fraudulent activity from both the sides, from the side of insurance company or from the insured person, and not mislead or withhold critical information from one another. Second one is, you are going to talk here, that is principle of insurable interest. So if you will see here, a type of investment that protects anything subject to a financial law. So here one important consideration is here, that if you are the owner of a specific property, if any kind of loss is going to come over there, so you will get affected by that. Definitely, let's say you have a car that let's say Mr. X is there, is having a car, so the owner of that car, so if it is going to get damaged or it is going to get in a particular mishap, so at that time only Mr. X is going to get affected by that, not others. So if you have a ownership of certain property, you have some kind of interest over there, and if that property is going to get losses, so you will get affected by that. So it should be followed under the principle of insurance. So further we are talking about the next principle, that is principle of indemnity. So indemnity, what you mean understand by that? Indemnity means minimization of losses. So it states that insured must be compensated for any loss or damage caused to the goods insured by the insurer, and it is not applicable in the case of life insurance, because once a person is going to die, you cannot make him alive. So this principle of indemnity is only applicable in case of the general insurance. Next one is principle of subrogation. The insurer pays for a loss to the insured due to the wrongdoing of a third party. Now, apart from this, principle of subrogation is the part of the principle of indemnity, and it arises because of one of the third party has commenced or has done such activity, and because of that, the insurance company will pay some kind of loss to the insured. Next one is principle of contribution. So if the loss arises and you have taken more than one insurance policy, then the loss will be covered by the policies based on the proportion of the coverage the insurance policies provide. Let's say you have purchased the car Bugatti Veyron, and you have contacted one of the insurance company, general insurance company. So that insurance company is there saying that we cannot cover the whole life whole general insurance for this particular car, so we can provide you insurance up to 60%. Somewhere you are contacting another organization, let's say for 40%, remaining 40%. So when any kind of loss will occur, so both the companies will pay you in the contribution. Now further we are talking about another principle of insurance, that is principle of mitigation of losses. You know that insurance we are talking here, so insurance is basically is going to cover the losses that could occur because of the unprecedented situation. So you can say that this insurance policy or insurance is going to help you out in mitigation of the losses what could occur in near future. Now next one principle, that is principle of causa proxima. So principle of causa proxima is basically what, whenever any kind of insurance a person is going to take, or maybe any kind of mishap or any accident or any kind of unprecedented situation is going to occur, so in that case insurance company is not going to pay you like anything. Firstly what they will do, they will examine what exactly the reason of that particular incident, and what is the nearest reason of that particular situation, or you can say that kind of risk that has been occurred, what was the reason for that. So they will examine, and based on that they will decide that how much insurance they are going to provide you. So I hope this is clear with you all. So we have discussed 7 principles of insurance. What is that? Principle of utmost good faith, principle of, one by one I am just making you recall for the recall. Principle of utmost good faith, principle of insurable interest, principle of indemnity, principle of subrogation, principle of contribution, principle of mitigation of losses, principle of causa proxima. So further we are talking about the organization that is going to regulate, or that regulate the different insurance companies that are working in India. So that is IRDA. So IRDA stands for the Insurance Regulatory and Development Authority of India. Now this was developed under the Insurance Regulatory and Development Authority Act 1999, and you know that this is a regulatory body and it works under the jurisdiction of Ministry of Finance, Government of India, and apart from this it is an apex body that supervises and regulates the insurance sector in India. So you can say that any insurance company that want to do work, means that is working in India, so they cannot deny the rules and regulation which is provided by the IRD, and if they do so, it means there's a violation of rules and regulations. So this IRD is having the right to shut down that company if they're violating the rules and regulations that is provided by IRDA. And apart from this, if we talk about where its headquarters, that is its headquarters is based in Hyderabad, Telangana, and where it moved from Delhi in 2001. Now, apart from this, it regulates the rates and terms offered by the insurance to bring equality for the different individual customers. It provides the protection to different individual investors. What could be the risk they can face because of the fraudulent activities of insurance companies. So this IRD authority will make sure that no such kind of fraudulent activity should commence from both the parties, from both the sides. And it will also specify the code of conduct for the surveyors and whosoever the loss assessors are there in case of any kind of mishap. So they will provide the code of conduct for the same. It will also help to promoting efficiencies and the conduct of insurance business, how the insurance companies are going to, what will be how they are going to do the work, what will be their modus operandi to do different kind of work over there. And you can say that each kind of insurance policies that are available in India, so all are going to be covered under the IRDA, and no one can no insurance company cannot avoid that. Okay, and all the rules and regulation that's provided by IRDA, that is must for everyone, must for every insurance company. Apart from this, I also want to tell you about insurance repository. So you understand the Prime Minister of India announced an insurance repository system helping the different policy holders that buy and maintain insurance policy in electronic form, rather than you can say that is going to helping policyholders to buy and maintain insurance policy in electronic form, we can say. Okay, and means if they want to purchase it on paper, so it is somewhere it is you can say this is not applicable on papers. So insurance repositories like shares depositories or mutual fund transfer agencies will hold electronic records of insurance policies issued to individuals as electronic policies, or either you can say e-policies. So I hope you got all the points from my side. Thank you everyone. Stay blessed, stay happy, and for more updates, like and subscribe my channel, that is Account at Ease. Thank you everyone.